Hi, everybody. This is Peter Schiff. This is Monday, April 20th, 2009. First, a little bit about the markets today. I know the Dow took quite a hit, down close to 300 points, led down by the financials. And interestingly enough, before the market opened, Bank of America came out with better than expected earnings. And I was watching on CNBC, and many of the analysts seemed very excited by these earnings. Maybe they expected the market to react positively to the earnings. But, it amazed me that they still can't see through this. They still don't understand the significant problems that these companies have. I mean, companies like Bank of America are basically insolvent. I don't care what they earn today or what they pretend to earn. The losses are enormous that are buried on their balance sheets. The companies are insolvent. Anybody who's buying stock in any of these financials ought to have their head examined. They're going to lose a lot of money. And if you own any of these, you need to sell. But also, apparently, after the market opened, I think the market was focusing on the fact that Bank of America said that they have to set aside X billion dollars for potential loan losses. They have to reserve for loans. And apparently the market sold off. Again, why is anybody surprised that Bank of America or any financials have to set aside reserves for future losses? I mean, these losses are going to be enormous. Everybody should know that. There should be no shock when somebody announces something so obvious. But obviously, too, a lot of these firms had huge runs. We had a big run in the financials. Of course, I mentioned that Goldman Sachs sold some stock, and that was probably a good signal that the run in the financials was over. But, if you actually look at the Bank of America earnings, to see how ridiculous they are, where did their earnings come from? There are two places. They came from sales and trading from Merrill, and they came from refinance, from mortgage refinances. Well, sales and trading revenues, that's not a really recurring revenue stream that you can count on. Because where did this money come from? It meant the traders at Merrill bet good. They bet right. Their bets paid off. Well, as anyone who's been to a casino knows, you can't consistently bet right. In fact, one of the reasons that Merrill lost so much in the past was because some of their bets that they made in the past ultimately turned sour, and short-term profits became long-term losses. How do we know they're just not doing that all over again? Then, when it comes to mortgage refinancing, well, obviously, every bank is making a lot of money doing refis. Because rates are at ridiculously low levels, the Fed is artificially suppressing interest rates, enabling people to refinance their mortgages. Now, this isn't going to be like this forever. This isn't business that Bank of America can count on quarter after quarter, year after year. This is only temporary. But also think about this. To the extent that Bank of America is refinancing their own mortgages that are on their books, if they had a mortgage that was paying 6%, and now they've refinanced it to 5%, even though they've earned a fee in the short run, in the long run, they took an asset that was paying 6%, and now it's only paying 5%. They're worse off. Their future earnings are being reduced because they're earning money doing refis. And of course, as interest rates ultimately rise, and now they have even lower yielding loans, they take a bigger hit. So again, this is actually bad news, but Wall Street will spin it as good news. But I think more importantly, what I really wanted to talk about today is this crazy editorial or op-ed that I read in the New York Times by Gregory Mencken, who's a Harvard professor and a former economic advisor to George Bush. And here's a guy who's got all the good credentials, right? A smart guy. I saw him on CNBC talking today. Much of what he said was accurate. But here he writes this completely nutty, crazy op-ed that demonstrates that he knows absolutely nothing about basic economics. What does Mencken want the Fed to do? He wants the Fed to create negative rates of interest so that people will spend more. He wants to punish people who save money and reward people who spend money. And the way he thinks we should do that is by creating inflation. So if the Fed just creates a lot of inflation and we devalue our money, then there will be a penalty for people who put their money in the bank. He said there's a negative rate of interest. If money is going to lose, let's say, 5% of its value, and you keep your money in the bank, then if you had $100, then you only have $95 worth of purchasing power. So he wants to use inflation as a way to encourage people to spend. And he thinks that if we all rush out and spend, then we're going to generate their economic growth. And he thinks that a little inflation is a small price to pay. That yes, inflation is bad, but not nearly as bad as this recession. And if we just create enough inflation, then we won't have the recession anymore. We'll just have the inflation, which isn't as bad. Of course, this is all absolute nonsense. Economic growth, as I've said before, is not a function of spending money. Economic growth makes spending money possible, but you can't spend your way to growth. You can spend your way into bankruptcy, and we've done a pretty good job doing that. The problem is all the spending that took place in the last several years, that is the problem. We spent money we didn't have. We went into debt. What we need now is to save our money. We need to replenish our savings so that we can produce more and so we can get out of this hole. The last thing we want to do is destroy the savings we have left, but that's what inflation does. Now, if Menken's plan was, how can we goose the GDP in the short run at the expense of destroying our economy in the long run, then I guess his plan makes sense, because that's all it does. If we all run out and spend whatever money we have left, and then we count the spending in GDP, yes, we'll get a bump in GDP. But at what cost? It's like, let's assume you're stranded on an island, and maybe you've got a certain amount of food, maybe you got enough food for a month. And Menken's plan is, let's just pig out. Let's eat all the food right now. Well, okay, great. That's great for a day or two, but now there's no more food, and now you starve to death. We don't want to deplete our savings now just because we can get a boost in GDP. We want to save. We want to create economic growth. Now, sure, there is a short-term sacrifice as we all stop spending money and all that phony economic growth goes away and we rebalance our economy. That's the price we have to pay to get our economic house in order. What Mencken doesn't want, he doesn't want us to pay a price at all. He just wants us all spending. He wants to encourage the reckless behavior that got us into this mess. And how can any economist advise that we deliberately create inflation, that we destroy capital, that we destroy savings, the most important ingredient in economic growth? We just destroy it. We punish people for doing the right thing. We tell them, don't save your money. Go out and spend it, because if you don't spend it, the government's going to steal that value away from you in inflation. And of course, once that gets out, that inflation genie is out of the bottle, we're never getting it back in. It's just going to accelerate. If we think that we can really buy economic growth with inflation, if we think, that it's worth it, that the trade-offs are worth it, why don't we go down to Argentina? Why don't we go down to Zimbabwe and say, hey, is it worth it? Is the short-term gain worth the long-term pain? How's inflation working out for you? It doesn't work. We need to save our money, and if it means a temporary drop in GDP, that's the price we pay. We need real economic growth. We don't need another fantasy. And, along those same lines, I noticed that the Congress is now considering a bill that I think they tried in Germany, which again is also misguided, which shows it's not just Americans that do foolish things, it's the Germans. But they had a program over there in Germany, Cash for Clunkers, where if you trade in your old clunker, the government gives you a tax credit to buy a new car. And we want to do the same thing here. We want to get Americans to trade in cars, I think they're 2001 or older. To trade them in will give you money if you buy a brand new car, not another used car, a brand new car. Now, this is one of the dumbest things we could do. We got a bunch of cars on the road, perfectly good cars. They can still run. Just because they're from 2001 or 1999 or 1995 doesn't mean we have to trash them. Doesn't mean we have to send them to the scrapyard. They're there. They work. We're in trouble economically. We spent too much money. We need to make good use of the cars that we have. Think of how stupid it is to scrap cars that work just so we can go into debt to buy new cars. And of course, the crazy thing about it is the tax credits are going to apply even if the new car you buy is an import. Even if you scrap, your American-made car and you go and you buy a Japanese car or the German car, the U.S. government's going to give you a subsidy. I mean, why not just drive your old American car, and at least if it needs repairs, you can go to a local repair shop and get it done. It makes sense. This is all nonsense, this whole idea that you just spend. Anyway, that's it for today. I'll be back again soon. So long, thanks.